with that, moving straight into the first substantive panel of the conference, which, as you know, is entitled Next Generation EU and Europe Economic, Monetary and Banking Union. I will ask the panelists to switch on their videos so that all the public can also see you on screen wherever you are across Europe and the world. And I want to welcome you all to the Rebuild Center virtually. We have a stellar cast of speakers to kick off our academic discussion, and I will introduce the speaker briefly at the start in the order in which they are going to present. So the first is Erik Jones, who is a professor at European University Institute, where he's the director of the Robert Schuman Center for Advanced Studies. He was for many years a professor of European Studies and International Political Economy at the Johns Hopkins School of Advanced International Studies, and he's one of the most well-known scholars on European integration and European political economy worldwide. The second speaker is Laure Clement Wilz, who is a professor of public law and European law at the Université of Paris-Est, Créteil. She is also sharing a chair Jean Monnet entitled Souveraineté économique européenne, and she is leading a research project focused on the strategic autonomy and the sovereignty of the European Union on economic issue. Then the third panelist will be Fabian Amtenbrink, who is a professor of EU law at the Erasmus University in Rotterdam. He's based at the School of Law. He's also the Vice Dean, the Director of Research since 2013, and a member of the board of the Erasmus Center for Economic and Financial Governance, and a well-known scholar on issues connected to European Economic and Monetary Union law. And finally, last but not least, my colleague Christy Petit, who is assistant professor of EU Banking and Finance Law at DCU, working both at the School of Law and Government and the Brexit Institute. Christy holds degrees from the EUI, the College of Europe, the École Normale Supérieure, and she was previously also an associate at the EUI Florence School of Banking and Finance. So we have a stellar cast of speakers, lawyers, economists from multiple countries and member states of Europe, and indeed the world. Each of the speakers will have 10-15 minutes for initial presentation. We are running slightly late because of a very long and insightful keynote speech by President Donohoe, but we also have a bit of a buffer in the coffee break. So I just want to reassure the panelists that they will have the time we have pre-agreed, and still there will be opportunity for Q&A afterwards. But without further ado, I'll immediately call on Erik to kick off and start our discussion about next generation EU and the future of Europe. Hi, Erik, good to see you.
It's so good to see you, Federico, and thank you so much for inviting me to help you open this excellent center that you're building. I love the idea of the center, and I'm very grateful to be able to participate in the conversation. As we agreed, I'm going to do the very awkward share my screen moment, and then try to provide a little bit of background for the subject that we have in front of us, which is a kind of a complex subject insofar as I'm not quite sure where the balance is meant to lie, and hopefully I'll be able to. There. Are you seeing the screen the right way, Federico?
Yes, yes, we are seeing it perfect.
Perfect. So what I really want to do is just make 4 very quick points. The first is that we really could not have got through the economic consequences of the policy response to the pandemic without the promise of debt mutualization provided by Next Generation EU. So when you think about Next Generation EU, even though the results of that program are probably less impressive than you might imagine, it was nevertheless essential. Second, the ECB did the heavy lifting in terms of debt mutualization, although Next Generation EU sets a valuable precedent, one might argue. In fact, the asset purchase program, the pandemic emergency purchase program, those are the really big debt mutualization positions that Europe has taken, and unwinding those positions is going to be a significant challenge. Third, we don't know what the reversal of a decade of monetary accommodation is going to do to the banking system, and I think we need to pay very close attention to that. All we do know is that Europe's banking union is still incomplete, and I take heart in the fact that Minister Donahoe has promised to work on that. I'm a little bit doubtful about the progress he's likely to make, despite the good intentions. And fourth, we still don't know what the new rules will be for fiscal consolidation and macroeconomic policy coordination. As Minister Donahoe pointed out, those are very much in discussion. Here again, I'm a little bit doubtful that we're going to see what we want to see. So let me go to the first point. We know when the pandemic started, there was a lot of concern in the bond markets. That concern was exacerbated by a communications error at the European Central Bank, and then the European Central Bank threw the pandemic emergency purchase program into motion, promising to buy unprecedented amounts of sovereign debt in a very flexible way in order to close the spreads. And the reason that I'm showing you the slide I'm showing you right now is to help you understand that the pandemic emergency purchase program on its own did not close the spreads. There was a temporary moment during which the spreads did close, but then they widened out again as bond market participants failed to give credibility to a European response that relied on monetary policy action all its own. It's only when the French and the Germans agreed to a recovery plan that was predicated on mutualized obligations, borrowing that would be joint and severally backed by the member states, that we got anywhere close to credibility in the market. And what you see in front of you is an image of this gradual closing of those spreads as that commitment made by France and Germany was made real in terms of institutions. And this is why I argue that Next Generation EU was essential. That said, Next Generation EU is smaller than you might think. If we start with the 2018 euros that the original plan was announced in, about 360 billion of that was supposed to be allocated in loans. And yet, if you look at the national recovery and resilience plans, what you see is that only 5 countries have actually requested loans as part of their assistance package. And those countries are Cyprus, Greece, Italy, Portugal, and Romania. There's a ceiling on how much they can get in loans, set at 6.8% of their 2019 GNI, so we're going to change the base here for our pricing calculations. If they max out the loan capability, they're only going to get about 166 billion. In other words, out of the 360, 200 is going to get left on the table. Already the number is smaller than the 750 we heard about. And that's before we ask how many of these member states are going to be able to push even their full allotment of grants through the public expenditure process. We know that Next Generation EU has a lot of effort behind it in terms of improving the way the public sector does its bidding and contracting, and yet nevertheless the timetable is unbelievably tight. And so I think we'll be lucky to see half of the 800 billion euros in current prices that Next Generation EU has advertised as offering actually spent in the form of new investment within the window where all the money has to go out the door by the end of 2026. And I think that's important for us to bear in mind. So Next Generation EU was huge for the credibility of Europe's response to the crisis, but it's actually much smaller than the headline figures would suggest. And so if I'm right, and I hope that I'm being too pessimistic, I would still argue that it's a major success. It's just not the major success in the way that many people might think it is. The ECB, by contrast, did an enormous amount of heavy lifting. Now, what I've done in this screen is put the balance sheet of holdings under the asset purchase program in the beautiful graphic that's provided. The largest share of that, about 2.6 trillion euros, is in public sector assets, in other words, sovereign debt. And then on the right-hand side, I put the table that shows what happened under the pandemic emergency purchase program. And when I say it was unprecedented, what you should know is that by the end of January 2022, they had already put through the door 1.6 trillion euros in new asset purchases, the bulk of which 1.58 is in public sector security. So this is an enormous program that now needs to be unwound. And unwinding this program is going to be very hard. And this is what the European Central Bank is talking about. They're talking about running off the PEP, which is supposed to end by the end of March, and then running up the asset purchase program so that they don't shock financial markets too quickly. But they need to run down the net purchases in the asset purchase program. They're arguing about doing that perhaps even as soon as the third quarter of this year. And then they need to start raising their policy rates and planning to run down the balance sheet of the bank, or at least letting maturing principal fall off. Now, I say all this because this is the way it's been told to us by the European Central Bank. But what you should know is that the pace is now much faster than anyone in the Governing Council had anticipated, even as late as September of last year, and certainly faster than the president of the ECB had told us it would be as late as December of last year. The pace has accelerated very quickly, and it's unclear what impact the war in Ukraine is going to have on price movements or financial market volatility or the success in unwinding this. So the ECB did a lot of the heavy lifting, and yet somehow getting out of that accommodation may be even harder than it was to respond to the pandemic in the first place. Now, I want to say all this stuff because what we know coming out of this is that there's a lot of things we don't know. We should expect increasing volatility in sovereign debt markets, but we don't know how big that's going to be. And we don't know what impact that volatility is going to have on the balance sheets of the banks and the private sector that we're relying on to help finance the recovery. Because as important as Next Generation EU is, if private sector finance doesn't step in, then it's not going to be the kind of sustained recovery that we need. We should also expect the banks to have to unwind this very complex subsidized lending that was developed. I haven't introduced that as yet, but the negative deposit rate that the ECB has introduced, together with targeted long-term refinancing operations, created an interesting subsidy that allowed the bank to push credit out into the private sector economy as they raised those policy rates. How is that going to come unwound? We're not quite sure what that's going to look like or what that's going to mean for bank profitability. And as we go into this period of extended uncertainty, what we do know is that the banking union still lacks a common deposit insurance scheme, that the funding for banking resolution is backstopped but not quite equitable across all parts of the monetary union, and that there may be problems that we'll face if there's a systemically significant financial crisis that emerges in the future. So despite the commitment of Minister Donahoe, I'm quite concerned that we're not making the progress and that we might need. I'm similarly concerned that we're not making progress, and this is my last point, in terms of macroeconomic governance reform. The threshold values that frame that governance process, the coordination process, the 3% and 60% that are embedded in the original Maastricht Treaty are very difficult to change. And it doesn't seem to be much desire by the German government or the Dutch government to change them either. It's very difficult to make exceptions for investment either. And if you think green investments would be easy to accept, then just look at the recent debate about green taxonomy. The adjustment path can be varied, and we can give the Commission more discretion in how it enforces the rules. But I think that these things might be more problematic than we're worried about. And so while I believe that there's a potential for change and accept the commitment to do that, I do believe also that there's cause for concern. And that brings me to my conclusion. I think Europe is coming stronger out of the crisis as a result of Next Generation EU, but that strength requires significant adjustment, which is why I talk so much about monetary policy making. There are important areas of vulnerability, and I would put those squarely in the financial system and in sovereign debt markets. And those areas of vulnerability extend all the way up to our rules and procedures for macroeconomic governance. So I think we're going to have to watch this space in many respects before we conclude that everything is okay. Anyway, thank you very much. I'm going to see if I can get out of this now.
Thank you so much, Erik, also for perfect timekeeping. I'm very grateful for this fantastic setting of the scene, which I think provides lots of food for thought, and I'm sure bits and pieces will be picked up also by the speakers that are coming next. So indeed, thanks a lot, Erik, for this wonderful presentation. And I hand straight over to Laure, who is going to speak to us from Paris and focus on something of great importance, at least from a French perspective, European sovereignty in the economic field, exactly what finance ministers are going to talk today about in Paris themselves. So Laure, the floor is yours, and I see you are sharing the screen successfully, so we can see that.
I'm trying to make a full screen. Okay. Can you see? Can you see the PowerPoint? Okay.
That's perfect.
Okay, thank you. I would like to thank Professor Federico Fabbrini for his very kind invitation. It's really a pleasure to be here and to participate to the birth of Rebuild. The topic that have been assigned is European Union after NGEU and European sovereignty. I will argue in this presentation that European sovereignty is more than just a political slogan, but not yet a legal concept. We need first a definition, even if it is a fussy concept. EU sovereignty, or sometimes EU economic sovereignty, puts under the same conceptual umbrella the commercial policy, defense policy, border controls, but also the promotion of EU environmental and social standards. It corresponds to both protecting and promoting EU interests and EU values. Substantially, EU sovereignty refers to the strengths of the EU towards the rest of the world and to its technical, industrial, and technological autonomy. EU sovereignty is mainly understood in its external dimension. It is often interchangeable with open or only strategic autonomy, an expression found in some preliminary recitals or secondary legislation. The former concept carries a much stronger symbolic charge, and the latter comes from international relation theories. There is also a different concept that all EU lawyers know, the autonomy of EU law. Towards the international legal order, the principle of autonomy of EU law has mainly been relied upon to protect the prerogatives of the Court of Justice. EU sovereignty has a much more performative function and brings to real institutional reforms. Quite on the opposite, autonomy of EU law has a defensive connotation. In order to address this topic, I will firstly present the origin of the formula in order to understand if there is a French agenda behind it. Secondly, I will present the relations between the NGEU and European sovereignty. Can we consider that European sovereignty is at the heart of NGEU or of EU law in general? Lastly, I will make some remarks about European sovereignty and governance in the post-COVID context. So first of all, the origin of the formula is relation with national sovereignty and the French agenda. Even if it was used before, notably by François Hollande in 2015, this notion was promoted by President Macron since he has been elected. They are both in line with their notorious predecessor, Charles de Gaulle, and his idea of Europe puissance, powerful Europe or Europe power. In 2017 in Athens, and his famous Sorbonne speech, President Macron explained how to build the 6 keys to European sovereignty. Most importantly, one of the 3 ambitions of the French presidency of the Council of the European Union is a more sovereign Europe, along with a new model for growth and a human Europe. Some scholars even consider that European sovereignty has become somewhat of a go-to concept in French government policy documents. The term was also used by other institutional actors such as Mario Draghi, Margrethe Vestager, Angela Merkel, Charles Michel, or Josep Borrell. So it became an influential notion and attracted the attention of think tanks and academics. Despite this Europeanization of the concept, its French origin brings into the front a more fundamental question. What is the relation between European and national sovereignty? This is more like a theoretical question. And what is relation with French sovereignty? And that would be more like a pragmatic debate. Considering or dealing with relation with national sovereignty, it is a very sensible question on a theoretical point of view, because traditionally and generally EU law is described as an instrument which limited or tamed, to quote Bayer's word, national sovereignty. The EU made sovereignty out of date. Neil McCormick argued that the new paradigm was post-sovereignty. In my opinion, notion of EU sovereignty is certainly reshuffling again the way to think the relationship between the member states and the EU in two contradicting ways. On one side, European sovereignty is a solution to the collapse of national sovereignty. Indeed, erosion of national sovereignty affects all states around the world. Thanks to shared European standards and a strong market power, the EU could protect European autonomy and strengthen the leadership of all European countries. But from another point of view, EU sovereignty is not a solution, but the problem. Indeed, to use a Comoric word, sovereignty speaks also to the imagination. And it is why this notion has been so much used in Brexit times and now in France in this presidential election context. Under this emotional dimension, European sovereignty can be seen as reactivating old fear concerning national sovereignty. Moving now away from this theoretical debate and turning now to the relation with French sovereignty or French agenda. It is not clear what the French government has in mind when referring to European sovereignty. On Twitter or in different political speech, Macron seems to refer to both European and French sovereignty, and hard sometimes to distinguish between both. And it is quite clear in the France National Recovery and Resilience Plans issued in this month that it is quite clear that in this plan we can observe a clear shift from European to French sovereignty, especially digital and cultural sovereignty. So one could fear of breaking up from dependency from the rest of the world, like China and the US, that would aim at recreating dependency within the EU and most notably in favor of France. So the NGEU EU law and European sovereignty. Is European sovereignty anywhere in EU law? I would argue that is at the same time nowhere and everywhere. Let me explain that. If we really read the hard EU law, you will never find the European sovereignty concept anywhere. You would find it only in some European Parliament resolution, such as the one issued in 2020 on the Sustainable Europe Investment Plan, how to finance the Green Deal. So the European Parliament calls for investment to be prioritized to support a sustainable transition, the digital agenda, and the European sovereignty in strategic sectors. With the same sentence in another resolution and in a couple of opinions of the European Committee of the Region or European Economic and Social Committee. So nowhere. But on the other hand, is everywhere if we focus on other related concepts such as the strategic autonomy. So, for instance, in the regulation establishing the recovery and resilience facility, there is the aim of strengthening the strategic autonomy of the Union. In the French National Recovery and Resilience Plan, the European sovereignty is quoted at least 70 times. In the regulation establishing the InvestEU program, there are areas eligible to contribute to the Union strategic autonomy. Also in some EU secondary legislation, such as the regulation establishing the European Defence Fund, and you have also other examples here in this slide, there is a direct reference to strategic or open strategic autonomy. For instance, European Defence Funds has to, some funds has to protect the strategic autonomy of the European Union. I quote, "The general objective of the fund is to contribute to Union strategic autonomy." Above that, we can even consider that the concept is a kind of everywhere without using any words directly related to European sovereignty. I would say a bit like the destiny of good administration, that was never there, but always there, till it actually reached the Charter and the treaties. For instance, in some NGEU related acts, such as this proposal and this council decision on the system of own resources, these two acts deal with the system of own resources of the EU, and they are meant to fund the NGEU. Through these instruments, among others, the EU affirms towards the rest of the world its interests and its values, and so it's promoting and protecting its European sovereignty. In other legal acts, like really very different, such as like the proposal to reinforce the Schengen area, or the proposal for directive on measures for high common level of cyber security across the Union, or all these proposals aims at they bring the idea of protecting the interests of the European Union towards the rest of the world. For instance, in the last text, you see this program aims to reduce Union's dependency from the third countries. To conclude this presentation, I will make a couple of remarks on EU sovereignty and European governance. As seen by an author like Verhelen, there is another blind spot in Macron's idea of European sovereignty, which is the institutional question. It seems that the definition of European sovereignty at the EU level would still be in the hands of the European Council. And as Federico Fabbrini demonstrated, that there is the risk in such a domination. Leading states then are dominating the decision process. Quite the opposite, as argued by Thomas Verhelen, EU sovereignty, it is a concept that evokes self-governance and democratization. To my point of view, as long as European sovereignty could innovate a lot of EU secondary legislation, it would give to other institutions such as the Commission or the European Parliament the possibility to have a say about it. Moreover, if NGEU implementation was referring to European sovereignty, it would empower other institutions such as the Commission, which is the main actor of the European semester. Thank you very much.
Thank you very much, Laure, for your contribution. It was really interesting to hear about sovereignty. Of course, I think it's only fitting that a French scholar speaks about this. And as you were giving your presentation, I was reminded of Jean Baudin, Les Six Livres de la République, where he says sovereignty is summa legibusque soluta potestas, the ability to give yourself laws with no one else over yourself. So I think you're probably right in saying that sovereignty is everywhere in what the European Union is trying to do recently, but not yet anywhere. So I think we will have the chance to come back to that. But before doing so, of course, it's now time for me to hand over to Fabian Amtenbrink, who I warmly welcome at DCU and at Rebuild. Fabian, thanks a lot for also joining us today from the Netherlands and bringing in a perspective, I suppose, from the Northern European views on next generation EU and monetary union.
I don't know, Federico, about that. Thank you very much indeed. I have no PowerPoint presentation to keep myself a little bit in checks. Well, first of all, warm congratulations to Dublin City University, to the Brexit Institute, and to you for the launch of the Jean Monnet Center of Excellence. And I wish you all the best with this new venture, obviously. And thank you very much for the kind invitation. let me, in one sentence, address the elephant in the room, and that is, while we meet here, events are unfolding elsewhere in Europe that have me very, very concerned. And I'm saying this because all morning I had actually quite difficulties in somehow focusing on the things that, you know, where to come, so I think our thoughts go out to those that are now subjected to war and violence and all that. I'm not known for saying these kind of things, but I somehow feel compelled to do so today. Moving on then to something completely different, as they say, next generation EU and Europe's monetary union after next generation EU. And I would like to make a couple of observations from kind of like a helicopter view. And my first observation relates to the role of the European Central Bank in the management of the economic consequences of the pandemic. And one, of course, is immediately drawn to a comparison with the role of the European Central Bank during the European financial and sovereign debt crisis, whereby there are some similarities, but even more so, a lot of differences. Now, in this earlier crisis, and most certainly in the early days thereof, the ECB has played an essential role in stabilizing the euro area, not only through the adoption and expansion of its unconventional monetary policy, but also through its contribution to the shaping and monitoring of financial assistance programs, for the better or for the worse, right? Now, this widely recognized role of the ECB as a crisis manager has, of course, not remained uncontested, as we know, as economists, policymakers, and legal experts have questioned the economic desirability and effectiveness, as well as the legitimacy and the legality of the ECB's approach. And it has resulted in the juridification of monetary policy. Most notably, it has triggered a serious standoff between the European Court of Justice and the German Federal Constitutional Court, with a focus on the scope of the EU's exclusive competence for monetary policy in the euro area and its delineation from the member states' competence for economic policy, as well as on the actual scope of judicial scrutiny of monetary policy decisions by the European Court. And this controversy surrounding the rejection by Germany's highest court of the ECB's public sector asset purchase program, and even more so, its rejection of the European Court of Justice decision validating the ECB action in the well-known case Wilz, for the time being has been what I would consider politically glossed over. Yet make no mistake, it can hardly be considered resolved as far as the underlying legal controversy is concerned, as will become clear from what I will note hereafter. Now, fast forward then to the current COVID-19 crisis. The role of the ECB in the management of the economic impact of the pandemic has been, at least in some regards, more subdued. And I can already see Erik going like, what? Subdued? Because he has rightly pointed out and demonstrated the significance of the ECB's purchase program as part of this pandemic. But hold on here for a second, bear with me. Now, there are obviously clear differences between the two crises when it comes to the nature of the economic shock and the economic situation of the member states at the outset of this crisis. And in the context of my presentation, slightly more important, also differences when it comes to the position of the ECB at the start of the pandemic. It was a different one. In fact, different to, let's say, 2012, the ECB's monetary policy stance did not provide for much of any room for an accommodative monetary policy stance beyond what had already been done, namely in the shape of downwards adjustments of its key interest rates before. Put differently, the ECB's conventional policy arsenal was pretty much empty. So apart from its specific pandemic-induced new approach to targeted longer-term refinancing operations, the ECB could be seen first extending its existing unconventional monetary policy programs, and shortly thereafter announcing the new asset purchase program, the Pandemic Emergency Purchase program. And again, Erik has highlighted already the significance of this. The ECB has defended the pandemic purchase program with reference to the prevailing economic situation in the euro area, which, and I quote, implied serious risks of fragmentation, which threatened to impair the smooth transmission of our monetary policy stance at the entire euro area. Sounds familiar? So while the disease that has been diagnosed may be a different one, its symptoms have been considered similar to those observed during the sovereign debt crisis, and so a similar medicine was prescribed. My second observation is that different to crucial moments during the sovereign debt crisis and the COVID-19 pandemic, the ECB has not been the only game in town. So some of you will recognize this phrase as a reference to Mario Draghi, which during the sovereign debt crisis stressed that in order to fully benefit from monetary policy measures, the contribution of other policy areas, and namely fiscal policy, is decisive. So put in less diplomatic language, a single monetary policy that is not complemented by a coherent fiscal policy is bound to be less successful. This, of course, directly relates to the well-known discourse on the asymmetric integration in EMU. Now, during the pandemic, not only the member states, but also the EU could be seen acting what I would consider more swiftly and more decisively in the economic policy domain than what could be previously observed. Member states have taken extensive policy measures to address the economic impact of the pandemic, including in categories such as expenditure measures, tax measures, measures related to public guarantees. And the EU's response to these major budget deficit and budget debt inflating measures can be characterized as flexible and accommodating. This applies, first of all, to economic policy coordination in the European semester, for which the escape clauses provided for in Council Regulation 14697, one of the two Stability and Growth Pact regulation, has been triggered. But this applies equally also to the what I call de facto moratorium on the application of the excessive deficit procedure. Even though by fall 2021, the average euro area government deficit was above 7% of GDP and the average government debt above 97% of GDP, based on a broad political consensus, the excessive deficit procedure provided for in primary union law has not been triggered in a single case since April 2020. Arguably more importantly, the EU itself has taken steps to increase its fiscal capacity, albeit for the time being temporarily and purpose bound. And I'm of course referring here to the main object of study of this conference, Next Generation EU, and its centerpieces, the European Union Recovery Instrument and the Recovery and Resilience Facility. Now, under these instruments, financial assistance in the shape of grants and loans are to address the economic consequences of the pandemic, and financing must be geared towards, inter alia, restoring employment and job creation, we heard this, as well as the reforms and investments to revive sustainable growth and employment. Now, next to beefing up its budgetary capacity, the EU has also introduced new crisis management mechanisms. Namely, we heard about this also already, SURE, the 100 billion European instrument for temporary support to mitigate unemployment risks in an emergency. Now, as part of this precautionary credit line lending tool, the ESM has introduced a new pandemic crisis support instrument, and there are other measures here I will not mention. What I will mention, moving outside the realm of economic policy, but which is nevertheless important when you consider the state of monetary union in 2022, is that the member states have agreed on an important element for the further strengthening, or if you want, completion of the banking union. And I'm of course here referring to the reform of the ESM treaty, effectively making the ESM the common backstop for the single resolution fund. Now, what is the impact on monetary union then of all of these measures, you may wonder? What is he talking about? What's the link here? Now, I would argue that in the current pandemic, fiscal policy, namely at the European level, is playing a much more prominent role than during the past crisis. this is not only recognized, but actually applauded by Europe's central bankers, which consider EU fiscal policy, the EU fiscal policy response to go, I quote, hand in hand and with being complementary to the ECB's monetary policy stance. From the point of view of the ECB, these developments possibly reduce the risk of history repeating itself to the extent that, as I have observed in the past, the ECB has taken a large portion of the blame for the EU's management of the debt crisis, whereas the European national policymakers and legislators were incapable or unwilling to act in a decisive and timely manner at the time. You see, the price that the ECB paid for this has been high, as in the view of some, it has abandoned its role as a neutral technocratic agency that exercises a clearly defined monetary policy mandate and has become a potential quasi-political veto player in the euro area. For now, there is much less controversy surrounding the role of the ECB in the managing of the pandemic, even though the ECB continues to engage in large-scale unconventional monetary policy operations. So what explains this? Well, one thing I would throw out here is that one major mitigating factor that may explain this is that the crisis-specific financial assistance for the pandemic in the shape of the Recovery and Resilience Facility is, of course, unionized. So conditionality is specified in Secondary Union Law Act, adopted with the ordinary legislative procedure and with the participation of the directly democratically legitimized European Parliament. The ECB plays no role in determining conditionality. We are talking about the adoption of legal acts, which in principle are subject to judicial review. So with a shift of focus from monetary fiscal policy also comes a shift or change of actors at the center of legal disputes. Very briefly, providing evidence for this view is the 2020 EU own resource decision adopted by the Council that forms the basis for the European Union recovery instrument. In Germany, the draft act ratifying this EU own resource decision has been challenged before the German Federal Constitutional Court with the claim that this law, and thus essentially the own resource decision and the rules it introduces on the financing of the temporary recovery packages, infringe the overall budgetary responsibility of the German Parliament, encroach upon the constitutional identity of the German Basic Law, and violate the applicant's rights to democratic self-determination. In fact, this claim is very similar to what the plaintiffs successfully submitted in the before-mentioned Vice case regarding the ECB's unconventional monetary policy measure. This is why I'm talking about a shift kind of like of actors or a change of actors. In this case, brought against the EU own resources, is also the specter of ultra-virus is resurfacing, sticking up its head again. While Germany's highest courts have unanimously dismissed the application for a preliminary injunction against this implementing act, the ratification, they have also stressed that it appears at least possible, they said, that the own resource decision infringes the before-mentioned constitutional provisions and touches upon what are considered to be unamendable parts of the German Basic Law. The decision is still, we still wait for the final decision. As the time allotted to me has probably run out quite some time ago, I'm not sure. Let me conclude this brief intervention then with the following observation. So on the one hand, it can be argued that Europe's monetary union, and namely its single monetary policy authority, is benefiting from next generation EU, both in institutional and policy terms. The ECB is no longer the only, to be more precise, not the only serious game in town. And you could say that this raises hope that in the future, the monetary policy does not have to counter or compensate for the absence of an active fiscal policy. On the other hand, the unprecedented volume of the recovery instruments could be considered to amount to an abandoning of the fiscal passivity of the EU that threatens the ECB's ability to exercise monetary dominance as envisaged by the drafters of the treaties. At least the question must be allowed here, to what extent the ECB may find its policy choices in the future constrained by the EU's newly discovered appetite for fiscal policy. Consider in this context, for example, the fact that the ECB's current public sector bond purchase does not only include sovereign bonds, but also debt instruments issued by supranational or international bodies, including the EU. And I think it was already mentioned that the EU will eventually become the third, I think it's the third largest bond issuer in euros. Reportedly, late last year, there have been discussions at the ECB whether the volume of purchase of such international supranational bonds should be increased beyond its current limits. Apart from the economic and political economy implications, it hardly requires any imagination to see that such a move would spark yet another round of legal challenges, with the ECB once again being at the center of the storm. And of course, I'm very much aware of the current debate on a possible policy change of the ECB, given current inflation forecasts over the medium term, which may change the situation. Thank you very much.
Thank you very much, Fabian, for your insightful presentation and for reviewing also all the measures that the European Union deployed in responding to the pandemic, including some of the challenges at legal level to both the ECB and in fact Next Generation EU that might await us down the road. And I suppose I also want to thank you for your opening point. I didn't mention it in my own opening remarks, but indeed it's a dark moment for Europe. And I think, ironically, even though most people do not associate the conversation we are having here with what is happening on the battlefield in Ukraine, perhaps, in fact, they are much closer than what we think, particularly if we embrace, I suppose, Laure perspective of a sovereign Europe. Having a strong economic governance architecture internally is a precondition to matter externally, I would suggest. But maybe that's for our follow-up Q&A session. For now, it's my great pleasure to hand the floor to my colleague and friend, Christy Petit, who will speak to you from Dublin at the Brexit Institute about the future of banking union. Christy, the floor is yours.
Thank you very much, Federico. Good afternoon or good morning, everyone. I also very much relate to the point by Fabian and by Federico. I faced the same situation this morning, so I can just repeat the same concerns and the same thoughts to everybody there. So to take part in this panel's discussion, so I'm looking at Europe's banking union after NGEU. Without repeating what have been already said by some of my colleagues or even by Pascal Donehu, I wanted to look at some very specific features. So as it has been emphasized, it's a fundamental breakthrough in the union's history, and it can be considered generally as a leap forward in European economic policy integration. And in particular, it has been presented as a game changer in the capital markets. Why is it so? So Florentine has given us some of the numbers, just to flag that indeed there has been huge appetite for highly liquid and also highly rated EU debt. During the second half of 2021, the bond issuance were very successful. So you have 71 billion euros that were raised. And Florentine told us a bit earlier today that we are close to 77 out of the 71 billion of pre-financing in member states. But this happens in a context in which, however, banks still have a strong connection with their domestic sovereigns. And some of those banks are actually involved in a primary dealer network. And I will get back to this notion and this concept, which is new as part of NGEU. And this is where you can see some of the connections and links with the banking union. So two questions that are relevant are the following. So what can be the role of the banking union in supporting the economic recovery in the context of NGEU? And what are also the effects of NGEU on the banking union developments? So in those 10 minutes, I would share some of the reflections to answer those questions. Of course, I'm very happy for feedback, for suggestions, for engagement on those, because they are to be developed within the Rebuild Center in the month and 2 years ahead. A bit more than 2 years ahead. So we heard some of the core feature. Indeed, under the recovery instruments, the EU uses its AAA credit rating to borrow on the capital markets at very favorable rates. But the beneficiary member states are liable for the repayments to creditors. And once again, the most important innovation corresponds to the inclusion of grants and in addition to loans, and that are to be reimbursed, including that via own resources and with all borrowings to be repaid by 2058. So this is a more long-term perspective even after the bond issuances. And just to give, I also like to mention some numbers and also just in terms of proportions. So the grants out of the total financial firepower, so when we mention to this financial power is not only NGEU, but also the multi-annual financial framework, that would be 16.9% of grants out of this massive package. Then we can discuss about the implementation, of course. That being said, so you can already observe developments that are very relevant for the banking union. The first is a safe asset that is in construction, because with the NGEU public debt program, we could observe de facto safe asset through the emission of Wilz bonds to finance NGEU, and which may lay the foundations for truly European safe assets. And that can be considered further in the design, but also in the rebuilding of the macroeconomic and financial architecture of the EU. And there is actually a high demand for this type of asset from different parts, savers, but also domestic financial institutions, and from emerging market economy. But just to be sure, from what I could read until now, if we look at all issuances overall, NGEU could represent about 5% of Euro area GDP. So this is remaining limited in size. So this is where I want to emphasize that we can see progress. We can see this nucleus, so to say, of a common joint debt, but it is worth noting that it is limited in size. And nevertheless, there are many academics, but also people engaged in the topics that are saying that those features are allowing us to consider the EU as a quasi-sovereign issuer. And here I'm building up on this notion of sovereignty. I'm happy also to hear other panelists on these qualifications. And also this expression of joint debt has been discussed, but it's to say that when you take the perspective of the credit rating agencies, they consider that the guarantee for this EU debt is equivalent to joint and several liability. So this is where this concept is being developed, even if it can be contested because each member state is liable to repay the debt, but there is a ceiling in the context of the own resource decision. So the EU budget is becoming liable when there is a beneficiary member state that might default on the repayment, but there is maximum amount determined in the own resource with an unknown resources ceiling. And I think we will get back to those points in the refinancing panel, looking especially on own resources. And another relevant development for the banking union concerns the potential further loosening of the bank sovereign nexus. So even during the pandemic, so the COVID-19 pandemic, banks have further increased their holdings of domestic sovereign bonds. And this is an issue of this famous doom loop, so the sovereign bank nexus, the fact that there is this vicious circle that we observed during the euro area and sovereign debt crisis between the banks and governments. But in the context of NGEU and the recovery, we could say that those issuance, and especially I will get back to it with the primary dealer network, can help in diversifying the banks and investment firms' balance sheets, which can in turn help to decrease the exposures towards domestic sovereigns to some extent. So this could be successful, once again, if it's more medium, longer term and with an adequate volume of issuance continuing to increase. And this is leading me to my next point, which is connecting in a way the banking union also with the capital markets union, because with the NGEU issuance program, there is a capital market activation, And the whole program is relying on the primary dealer network. So this is that way that the Commission is ensuring a steady, regular market presence. And within that network, there is a large and diversified investors base. And this is where you find at the moment, so end of February 2022, you have 43 private institutions. And among the eligibility criteria, they are established and having their head office in the Union and or in the European Economic Area country. They are credit institution or investment firms properly authorized and supervised within the EU financial system, depending if it's your area, the banking union, or outside with the EFSFs, or primary dealer for another European issuers. And here we can read EIB or ESM. So with this primary network dealer, the Commission is relying on the performance of those issuers that are then acting on with primary issuance and on secondary markets. And one of the conditions of the success is that the Commission needs to monitor that network that supports the market operation and also the placement of EU borrowing. So this is increasing. I think at the very start of the network, it was nearly 41 institutions. So you have new applications, and the objective, I think, is to have the widest possible network. Also to kind of overcome some of the biases that are actually present. So for now, there is an overrepresentation of specific member states and no participation from others. The bigger economies are represented if you look at the list. But there is an obvious link between that network and the first pillar of the banking union in particular, because if you look at this list, a big part of the financial institutions admitted to the network are actually supervised under the direct supervision of the ECB. And to develop my last point, I wanted to focus on a more specific question, which is how can the banking union contribute to the NGEU objectives or overall rationale? And here, some steps have already been partly taken in a way, or achieved maybe would be too optimist, but Florentine emphasized indeed the objectives. So to allocate 37% of the RRF to green investment, 20% of the fund to digital investments, and these correspond to the transition, green and digital transitions. So here, just to flag the first very successful NGEU green bond issuance that amounted to 12 billion euros last October, and this will continue. And so this is where you have specific policy areas, but on top of those policy areas that are favored, there can be some evolution undertaken at the supervisory and regulatory level. And to be even more specific, I think it corresponds to those instruments that are in the hands of the supervisors, or the acts that are contained in the single rulebook at the first, at the second and secondary and third level, that can also play their part in this specific policy direction. So just to be even clearer, if we take at the supervisory level, it is already the case for supervisory expectations that have been set, communicated to actors as regards climate-related and environmental risks in the course of last year. At the regulatory level, if we look at some of the measures that are being proposed, so as part of the legislative package of October 2021, there is also some measures that we can fully put in line and are acting in parallel to those policy objectives attached to NGEU. So to conclude, the strong presence in the market will continue in the first half of this year, so 2022. The objective is to raise additional 50 billion euros with both conventional and green bonds. So that would lead to 15% of the final target of issuance by 2026. And definitely the significance of NGEU at the EU and transnational level will transform the EU's economy in terms of the recovery, but also with greener and more digital activities. Of course, the sustainability of this scheme relies greatly on the success to levy new own resources, and I think we will debate that further tomorrow morning. And I would have actually opening questions maybe to ask if NGEU could lead to a unified debt market in Europe. I read some prediction about having a market for Eurobonds in 5 to 10 years. So I'm not an economist, but I'm happy to hear about some of the co-panelists or the audience, what they think about that. And another concern I had while I was preparing for today is also how to combine the short-term and long-term dimensions, because some of the issues and shortcomings that we observe in the banking union, capital markets union need really to be addressed in a long-term perspective. And it is somehow in tension with the temporary and exceptional character of NGEU at the moment. I know that Florentine also emphasized the fact that all the reforms and the recovery programs at the national level will have a long-lasting effect. But still, we have this tension, which is interesting to discuss, and probably we can find some solutions altogether. So thanks, I will stop here, and I'm looking forward to the discussion.
Thank you very much, Christy, for your presentation, including for bringing into the picture the question of the future of capital markets union in the European Union, which is certainly an important aspect for financial markets operators. We have now at least 20 minutes, but possibly even more, for some questions and discussion. And given the number of people in the audience, I think we can make it live. So if anyone has a question, please raise your virtual hand or drop me a message, and we will be able to unmute you or allow you to unmute yourself so you can directly ask your question to the speaker. We had a fantastic panel with political scientists and lawyers covering a lot of topics, so don't hesitate to come forward and take the opportunity to ask anything. I really much enjoyed the presentation and the conversation, but I suppose an elephant in the room or a big question that perhaps we should address is really whether Next Generation EU is a transformative event for Europe or not. Now, of course, I think we at the Rebuild Center claim that it is. We decided to create a center precisely to analyze that, but I must admit I was also very much convinced by some of the points you, Erik, for example, made at the beginning, that at the end of the day, the financial firepower of all this program might be less than what officially advertised, because states are not asking for loans. And I also was frankly convinced by many of the points that Fabian made, that yes, the ECB is no longer the only game in town, but some of the challenges of EMU that we knew from the last decade are remaining. So are we moving toward a European fiscal sovereignty, as Laure would have put it, or are we in fact, is it a revolution, or is it just an evolution for economic and monetary union? Perhaps the speakers might address this point, and once again, I'll invite everyone to raise his or her hand to discuss this. Fabian, you want to go first? Okay.
I can't find the virtual hand. Desperately trying to find the virtual hand. It's not an old hand, it's a new hand. That's the other thing I learned about old and new hands. No, just picking up on this. I think it's maybe one of the most fundamental questions in the sense that we know it's temporary, we know it's purpose bound. So the really interesting academic question, of course, is what's there to stay beyond that? What the investments will do, of course. And I think the question then, part of this question then is transformational event towards what? So if the answer is, well, to the fiscal capacity that so many have longed for, or at least asked for, as a counterbalance to the monetary union and the exclusive competence of the in EMU for monetary policy, of the EU for monetary policy, I think the answer is if some of what we see now would be here to stay, it would increase fiscal capacity, but it is not the answer to it. I will not go into details, but I think the reason for this is that fiscal capacity, if you look at the literature, means all kinds of things, but it certainly, you can identify certain key elements that contribute to fiscal capacity, such as, for example, what is the budgetary capacity? Such as, for example, indeed, common debt issuing, such as, for example, robust crisis mechanisms for the future, but also, for example, fiscal policy rules that are sound, credible, and that will actually be applied. So it's really a package, and Next Generation kind of like touches up on some of these issues and maybe breaks some ice, possibly, and some taboos. But you know, but one should not probably have too high hopes that this kind of like is it already. Thank you.
As the British would say, the proof of the pudding is in the eating. So thanks, Fabian. I'll head straight to Erik.
So thanks, Federico. And I think you're asking the right question about how transformative this really is. The point I would make is that even if the financial instrument is temporary, the treasury management and fundraising capacity that's going to be built in the European Commission is not temporary. That's permanent. We saw that being used for sure. Now it's going to be expanded. And what we also learned last spring, or in the spring of 2020, is that the ESM, for reasons that may be warranted or not, is radioactive for those countries most likely to require it. As a consequence of which, the ESM, despite the recent treaty revision, is actually declining in significance, while the European Commission is rising in significance. And if we need to borrow money collectively at some point in the future, it's more likely to be borrowed by the Commission than it is by the ESM. And I think that's a very fundamental shift. I also think that we should look closely at the analytic capacity that the Commission is acquiring in order to enforce the conditionality attached to this financial instrument. The templates that were required for national governments to put in their recovery and resilience plans were far more intrusive, far more detailed than anything I had ever seen before. And the closeness of the monitoring to which they're being subject is much more much more intense. I don't intensively modify closeness, but you get the idea, right? It's much more intense than anything I had imagined. And I think that analytic capacity is not going to slough off either. So I think the Commission is coming out of this as a changed institution. What that means for the future of Europe depends a lot on the point that Fabian raised about the Own Resources Directive, because at the end of this, we may find ourselves on the hook for 400 to 500 billion euros worth of debt without new own resources to cover that gap. And if that were to happen, I think we would be telling a very different story about the lasting consequences of Next Generation EU.
So path dependency, I get. I wonder whether Laure or Christy also want to jump in on this point. Laure.
Yeah, I would also say that it's more than just an evolution. I think it certainly is a revolution, because it creates a fiscal citizenship that was not existing before. So because now that we have, I mean, the EU will need to create direct tax to refund, to reimburse the loan. So and this is something that the European Union never managed to do for years, and this is also a permanent shift. I mean, it is not temporary. So that would be the birth of this what I would call the European fiscal citizenship. And we can really think, and I'm going back to my presentation, of a new paradigm. You know, what has been much said about European sovereignty is a new narrative for the EU. After European integration, you know, that we all saw that maybe it was a little bit, you know, without driving force, that European sovereignty can give a new, a new paradigm for the European Union. And because the NGEU always tends to protect or promote European sovereignty, we can really, yes, we can qualify it as a revolution and really a huge shift in the European Union process, evolution, yes.
The revolution is no representation without taxation, instead of no taxation
exactly.
without representation. Christy.
Thanks. Well, without repeating what has already been said, I would just focus maybe on, so I would say it is transformative for one reason, one overall reason, which is the intergenerational impact. I know this is a simple comment because this is leading back to the name itself of the program, so next generation. But when you look at the policy areas, you look at the structure, the time frame, so until 2058, the fact that the structural reforms that are embedded in the national recovery plans are meant to be future oriented and hopefully are meant to be beyond the political cycle. So this is where I would emphasize the intergenerational dimension and being hopeful and being positive about it, saying that it's a transformative and positive impact, because then we are giving ourselves a means and the capacity to act within the green area, within the digital area, and so on and so forth. And not to forget the inclusive aspect, but this is more for the intergenerational dimension, which is more fighting inequalities, but this is maybe another point. Thanks.
So thanks to you all for these initial reactions. I'm glad we have some questions coming from the audience, and I want to give the floor first to Amy Verdun, then to Monica Bodini, and finally to Gavin Barrett. Amy, I think you should be unmuted and able to speak, and maybe we can see you too. There you are.
Thank you very much for giving me the floor. Thanks for these wonderful presentations and for giving us some insights about where we're at right now with regard to the next generation EU and the responses by the EU to the various economic and monetary crises. So each of you in your own ways alluded to the Ukraine crisis very, very briefly, and obviously it's not the main topic of this conference today, but I think as Federico was already saying, this may be closer than we think at first sight. After all, in order to do anything militarily, one needs to have sort of some form of unity. We need to have some form of solidarity and the willingness to take risk together. It's been an area in which a lot has happened, but not enough to actually feel that the EU can stand on its own 2 feet. So I was wondering if one may be able to also combine this with the very reason why this institute, and congratulations, Federico, has been created, the Brexit Institute. And I saw Alan Menon on Twitter very recently, maybe earlier, a few hours ago, saying, you know, the UK left allegedly for all kinds of things they didn't want, that they're now actually imposing. And on the other hand, so things like, you know, worker security, safety, health and safety, all these things that they said they weren't so interested in, but now are having to deal with the consequences of not being part of an entity like the EU that would have a closer sense of connectivity. So I was just wondering if the panel was able to make that connection between sort of having that, built that sort of solidarity, financial basis, and a deeper integration, and this challenge that we're posed by the movements on the ground that we see today. Thank you.
Thank you, Amy, also for connecting super early in Western Canada. It must be early morning there. Let me collect also the question from Monica.
Okay, the camera should also work.
Yes, we can hear you. We can see you. Hi, Monica.
Hi, thank you for giving me the. Hi, Gavin. I see you now. There are a lot of friends here. So my question is for Fabian Amtenbrink. Maybe it's a bit different from the topics you were discussing, but he mentioned it. I'm interested in what you're talking about today from the point of view of its impact on the development of the forms of government. So for Amtenbrink, the question would be, you talked about the Vice ruling, and we are waiting for another ruling. Maybe in 3 years we will have it. because the Bundesverfassungsgericht accepted the last Verfassungsbeschwerde last year. And my question is, do you think there is the chance that the Bundesverfassungsgericht will decline somehow in a different way from the Wilz ruling, the notion, the legal notion, I mean, of constitutional identity, maybe by reasoning also from a constitutional point of view on separation of powers, and therefore writing, if not complete different ruling compared to the Wilz one, but somehow a new ruling from the point of view of the ultra-virus problem. Okay.
Thank you, Monica. I will call on Gavin to also ask him his question. So we collect three and then we go back to the speaker. Hi, Gavin.
Hi, Federico, and congratulations on the launch of this enormously important initiative. It's great to see it going, and of course couldn't be more important at the present time. So well done on that, and thank you to all the speakers. I participated in an event yesterday myself on a rather similar topic, in which Professor Maria Kendrick questioned the ability of the European, the various methods that have been suggested of repaying the money. So I just wanted the speakers, maybe if they could, to ask how they would rate the European Union's chances of paying this back with the various methods that have now been suggested, and what happens if they can't?
Thanks, Gavin. So I propose we take these questions in the same orders of presentation. So perhaps starting with you, Erik, and some questions were directed to all, some were more specific. So I leave that to each of the four panelists to choose.
Well, thank you, Federico. I'm definitely going to stay away from the law question. So what I'm going to do is, Gavin, the three sources of funding that we've had indicated to us are a levy on non-recyclable plastics, which is actually a country-specific levy, and it has discounts that are country-specific as well. So that's not going to solve the problem, right? We've also got the emissions trading and carbon border adjustment mechanism. That's potentially a very lucrative instrument, but then you're adding cost onto the use of carbon at a time when gas prices are already high. So I'm curious to see what the political will is going to be around that. The third was the digital services tax, and we've just had this long conversation about corporate tax more generally that seems to have taken a lot of the air out of the room on taxing digital services per se. So we're left with the possibility that we may not get agreement. And remember, all this is going to be negotiated in the run-up to the next 7-year multi-annual financial framework. If they don't come to agreement, then they're either going to have to do additional levies across the member states in proportion to their contributions right now, or they're going to have to sacrifice spending programs from the next multi-annual financial framework in order to create the financial space to amortize the debt. The good news is that the debt doesn't need to be amortized completely in the next multi-annual financial framework, but a good chunk of it will be run off. So there's a potential there. On the Ukraine crisis from Amy, I think that the solidarity is going to be tested in the sanctions regime, but I would note that the sanctions that were imposed in 2014 held together far longer than anyone who was writing on sanctions at the time ever imagined, and so that's a good sign. The other thing I would say is that if you look at this crisis not just as the tragedy that it is, but as a way of convincing Europeans that they need to pivot away from a dependence on gas from Russia, one could expect next generation EU to be even more important in helping us re-engineer our energy economies. So thanks.
Thank you, Erik. Laure.
Yes, I was trying to consider Ami's question, which is I find a very interesting but very hard question, because it's like always like, how to link NGEU with the military action of the European Union, and was really looking, and I really don't see any possibility to link both, because anyway, military action, they are much more, based on member states cooperation, and apart from what Erik mentioned, like the economic sanction, there is no, I mean, even if we try to put everything under the same conceptual umbrella, even if we call it European sovereignty, these two branches are very separated. So I'm really struggling with answering to that question, because I don't see, yes, apart from now the need once again to be more independent on the like our resources from Russia, but I really don't see, maybe someone else has an answer, like if the NGEU could somehow, you know, have an influence on the defense strategy.
It's a good point, Laure. What comes to my mind, but I'm not a panelist here, is that, of course, once you have debt, you can use it for all purposes. Now it's to pay for recovery and resilience. Tomorrow is to pay for common military purposes. But perhaps we'll come back to that.
Now, I mean, if we need it now, it's a little bit late.
Yes. Fabian.
Well, thank you very much, and yeah, great to see all of you, Amy, Gavin. So, like, indeed, lots of people. I wish I would meet in person more often these days. Anyway, maybe in somewhat half reverse order, Gavin. Actually, I would add a question to this for Erik, actually, and that is: does it make a difference who holds the bonds? Does it make a difference who holds the bonds, to the extent so that the ECB is, and I have no concrete information on this, how much of the debt issued by the EU is held by the ECB, and does that make any difference for answering the question, what if the EU cannot repay? So I'm sort of like, I'm curious about this myself. Amy, yeah, I mean, really interesting question. Solidarity and you know, I think the kind of like halfway cynical answer is that, you know, solidarity, de facto solidarity, is quite often based on a shared sense of urgency, you know, based on a common threat that somehow that we share, and I'm very much afraid that, you know, until such moment that whatever aggressive force of whatever country is basically standing at our borders, or even worse, until such time, I'm not sure that in the area of defense we will really see this solidarity. But I stand to be corrected. And I wish I could avoid Monica's question now, because that's a difficult one. Yeah, could they decline the notion of constitutional identity? Look, I mean, obviously, I don't have the answer. My suspicion is that the case will not be successful. In the end. Even if the judges in this interim measure case have said, well, look, it's not entirely implausible, but that doesn't mean that in the end also they will actually accept these arguments. I think the focus really here is on the principle of democracy and the role of national parliaments, democratically elected national parliaments. And this principle of democracy, as most of us will know, in Germany is protected by an eternity clause, this famous Article 79, paragraph 3. So the focus then really in this concept principle of democracy and the role of national parliaments will be on, one of the focal points will be, to what extent are the budgetary implications, implications of the own resource decision, and what results from this, to what extent are they foreseeable for the national parliament, in a way that national parliaments can basically still exercise their budgetary responsibility, which in the German context, as we know from years of case law, is considered to be at the heart of the right of the parliament, which itself is at the heart of the principle of democracy, which is protected by this eternity clause. And once you touch up on that, essentially you are in the realm of the constitutional identity. And then when you think about this, then I think there are good arguments to say that you know, it is certainly foreseeable. It is not limitless. It's temporary. There is no such thing as a shared and several responsibility under these mechanisms. But this is just sort of like a very brief reaction to this, as it would basically be a whole seminar on its own to discuss these questions. Thank you.
Thanks, Fabian. And perhaps if Christy allows me, I'll give back the floor to Erik. If Erik, you want to answer to that specific question that Fabian was raising. So we'll leave to Christy the last word.
So the question that Fabian asked is what happens if the European Central Bank has on its balance sheet all of the European debt, and then we can't repay it? Can we just allow the ECB either to let that debt disappear or to be rolled over ad infinitum? And the interesting answer to that question comes right out of the Wilz decision. I think where there was a consensus between the Bundesverfassungsgericht and the European Court of Justice is that you can't infinitely roll over the debt without that being the monetization of debt. And since ultimately this debt is a liability of the member states, monetizing a liability of the member states would probably be unlawful under the European Treaty. So you don't get around that by the location where the debt is held. Having said that, for the ECB, buying all this debt is actually really useful because that's going to help them to keep their balance sheet out without being skewed off of the capital key. Whether that usefulness remains important in the future where we're facing higher inflation rather than lower inflation remains to be seen.
Thanks, Erik. And now back to Christy for final words from the panel. Thank you.
I will just focus maybe on the chance of paying back. Of course, I cannot I cannot read in the future, but I can just comment on the fact that if we look at the moment, at the current situation, the chance is rather on the low side because of the political uncertainty, but also because if we look at the numbers currently, they don't really add up. I mean, when in looking at the impact assessment, because of course we already had this announcement of new own resources, so you have a bit of data, etc. And from what I gathered, so in the years 26 to 30, so counting on the fact that there is an agreement, etc. If you look at the free new own resources, there would be only 17 billion annually for the EU budget that would be generated on average. So 70 billion multiplied by 4 is 68 billion. We'll look at the numbers. This is not enough. So this is just to substantiate the numbers do not add up and the political uncertainty. So I cannot really rate, but I just say that it's on the low side. Thanks.
Thank you very much, Christy. I think this panel touched on lots of still open questions.